Hello, Josh.
Happy Friday, Richard. How are you, man?
I'm good. Good to see you. How are you?
Likewise, I'm doing well. The folks are probably gonna feel a little bit more energy. This is the first time that we've recorded around lunchtime, man. But I'm firing on all cylinders. 2 cups of coffee in. This will be a good one.
All right.
Um, and I instead of sharing my screen first, we start our weeks every other week with this like, how are things going? And I feel like I'm beating this dead horse of like every week there's bad news and I feel like I'm maybe getting a little redundant or repetitive. And so I wanted to switch this up just a tad. And when I ask that question of let me get a temperature check, how does Richard feel? I was curious if maybe you could explain to me or to the listeners um, just what factors or what variables you're taking into account when you're observing or looking into the markets. If you're trying to determine are things frothy, is this just noise, and are things maybe overestimated, or are they too high at the moment? What types of metrics, variables are you looking at when you take a peek into the markets?
I guess I've just kind of curated my preferred sources over a couple of decades of being in the markets, right? And then also, of course, I'm a cycles and seasonals fan. I was actually thinking of showing you like the very first website I ever built
Okay.
is seasonaltrader.com. And this is still up and running. Let's see, I think it's over here. So this is it. I don't have any financial interest in this anymore. It's run by my colleague, friend, Jake Bernstein, who introduced me to seasonals. And I literally ported this website from a CD-ROM in like 2001 to the internet, and it was one of the first financial websites. It's clunky, but it's got a lot of great stuff in here. So, for example, in 1950, Dow Jones Industrial Average back to 1950 in the month of October. There's this still mind-boggling trade where, if you go long the Dow Jones Industrial Average on October 27th and sell on January 14th and use a 12% stop over the past 62 years, you win 90% of the time. And you can see that in this still clunky chart. This was all these years are up years. There's only been 1, 2, 3, 4, 5, 6, 7 down years out of the past 62, 63 years. So just a little bit of history there, of how long I've been making financial websites now, but also looking at seasonals. So, we're in a seasonally bearish period right now. I look at sentimenttrader.com, which is sentiment data on the markets. So I think that's important. And then I have 20 plus years of feel at this point, right? I mean, it is something that when you do it over and over again every day, like anything, you get an intuition and a certain level of familiarity with the markets that is useful. And of course, tying it all together with risk management. But overall, right now I still feel like there's more downside ahead, but with the caveat that so many people think there's more downside ahead and so many smart people think there's more downside ahead. that often, can end up backfiring, so so I have a few sources. I have my own experience of 20 years. I have my own feel, and then I use cycles and seasonals. But the most important thing is risk management and making sure that you survive, that you don't get blown up, and that you can, be in your positions long enough to have them work out for you. Because I'm convinced that most of the underperformance that independent retail investors experience is behaviorally driven, and not because they have bad tools or bad ideas or got bad recommendations.
That first, what an awesome website, man. That cool to take a peek at that.
Yeah.
I ask that question probably a little selfishly, like, week over week, every couple of weeks, we're talking about where things are at. And we've talked about this a lot. There's so much noise and there's so much going on that it's hard at any point in time to get a grip on like what is real and where are we at. And if I'm looking at an individual stock, or maybe I zoom out and I just look at the markets and I'm trying to determine just stock market valuations and where things sit. There's just, you can look at several news sources and find things on one end of the spectrum, find things on the other end of the spectrum. It's just so hard to find a right answer. And I've done some homework here. I'm maybe 6-7 days in on this term, so I don't want the listeners to just destroy me. But have you ever heard of the Buffett indicator?
I'll say no.
I'm going to show you a website here. I thought this was really interesting. And again, I'm still trying to put my arms around this. So maybe we'll learn it a little bit together. But first, Buffett turned 92 last week. So it only feels right that we're talking about him. I'm sure he's listening. So happy birthday.
Right.
One of his favorite ways to evaluate or look at the markets is what they now call the Buffett indicator. And it's this ratio of total market cap to GDP. So the value of public entities to actual economic outputs, if that's what we want to call GDP.
Sure.
This indicator today is at 170%, which, 170% sounds high. It's a lot. You look at this graph, it's a lot. But when compared to the dot-com bubble of 2020, which I think we've reflected back on a handful of times, at that point, it was about 140%. So things start to come into perspective and like where we're at today, especially when you look this back into 95. Just curious if you'd heard of this and maybe use this, thoughts, feedback on this as an indicator. And, as the first question was like, what variables are you looking at, or what are you using? Thoughts on this?
It reminds me a lot of the chart that we talked about from Ben Hunt a month ago, of kind of the total wealth of the country, personal wealth divided by GDP. So this is like stock market wealth divided by GDP. And what you see is that there's a disconnect there, right? Or that it's really that ratio has gone way up over the past 20 years. And to me, the most likely explanation for that is central bank action, liquidity, right? By whether it's quantitative easing or the stimulus, but the central governments and central banks creating a wealth effect that ultimately is now driving inflation, and that air's got to come out of that bubble. And so that is why a lot of smart people, those recently on Sentiment Trader, I think this was in a tweet from Jason Geffert, who runs Sentiment Trader, but institutions hedged to the downside. Okay. So hedged downside risk at historic levels over the past couple of weeks, unprecedented, like 3 times more hedging than happened in the 2008 financial crisis. Okay. So it was like a number that never been seen before. And Jason, he's been in the markets about as long as I have, maybe a little longer. He says Like I've never seen a chart like this in 20 years. Sometimes you look at a chart and it just blows your hair back. So that was me rubbing my non-existent hair for anyone who's just listening. So anyway, there's a lot of fear right now, and for good reason, because of charts like that. Yeah. When you see that the stock market wealth, right, versus the actual productivity of the economy is at unprecedented levels, even way higher than the dot-com boom, and we're down what, 15% off the highs. We were down 20% plus. We had this rally back, and yet we're still way above the ratios of the dot-com boom. So is this some new world that we're living in where wealth is somehow not manufactured from productivity? Right? That it's manufactured from what? If it's not manufactured from productivity, maybe from technology, from energy, but energy costs are going way up. So if you think through it, the logical course of path of least resistance is down, right? And down significantly from where we're at. So that's what, that's clear. Meanwhile, just because that's clear doesn't mean that's what the markets are going to do. So they'll do it eventually, but markets don't follow the timelines that everybody thinks they're going to follow because, they're anticipatory systems, right? So you have everybody trying to outthink each other, and that's just markets. They're not about what's going on in the moment so much as kind of anticipating what's going to be going on in the future.
It's a perfect segue into this. That you study cycles and trends, and talking about how hard it is to know, especially now, where the puck is going with the market. I've spent several days, like I mentioned, with the Buffett indicator earlier, of trying to find just some right answers outside of our conversations. And here's something that I thought was really interesting. I'll show this with you and see if just cycles wise, maybe this is something you're familiar with. But I've found that over a long period of time, and I've got some dates for you, September proves to be the worst investing month across the year. And I've got some numbers for you. Bitcoin, the last 9 years in September, 6 of them, Bitcoin has been down average of 7% in September. It's worse than any other month in the year. Ethereum, the last 6 years, it was down 4 of the 6. Since 1928, what I'm tracking here on the screen, since 1928, stocks are down 1.1%. This is the S&P 500, down 1.1% in September, which you can see on the graph, man, is by far the worst. Curious if you're tracking something like this. Are you aware?
This is seasonality, Josh. This is seasonaltrader.com, that I built back in 2001, 2002. So yes, and what's amazing is that these patterns persist in spite of the fact that everybody knows about them.
So what's going on? What is that?
I'm not sure. I don't think anybody really knows. I'm the chairman of the Foundation for the Study of Cycles, for goodness sake, and we don't have an explanation. So, but these cycles do persist. These patterns persist. There's lots of them. There's the presidential cycle pattern. There's a 4-year pattern. But the most powerful one is the 1-year seasonal pattern. So, I have a theory, which is that, people are on vacation during summer, right? Wall Street's in the Hamptons, whatever. They come back and people want to kind of find out where the equilibrium is in the markets. And so you want to find out where the bottom is. And you're not really comfortable until you have some level of confidence, that you've kind of done your soundings, over the sea of the markets, and you have an idea about where the bottom is. Where can you get your feet under you? Where can you minimize your risk? So it's just a theory. I don't know if it's true or not, but I think, that everybody knows there's a strong rally into the end of the year, early January, and the fourth quarter rally. And so let's spend the third quarter in September, which is really the only quarter of the third quarter that we're the only month, right? Where maybe September and October, where we're actually back from summer vacation and markets are really fully staffed, if you will. So that's my thesis. I don't know if it's true or not. Doesn't really matter though,
You're right. It doesn't matter. The fact is it exists. It's been there since 1928 or whatever it is, and it happens. And I think that's probably the more important piece.
Yeah. And for people like us, who are just, we're not interacting with, we don't sit on the boards of companies, we don't have the access that Warren Buffett does. We're always interacting with some kind of derivative layer of the markets. We don't interact with the companies themselves. We're interacting with information. We're interacting with image, with story. And so, we're never going to know the reason that's happening. And there's this kind of premium on false certainty in our culture that somehow more information and more data gets you better outcomes. And it's been shown over and over again that's not actually true. That a lot of times heuristics and kind of rules of thumb are much more effective decision-making mechanisms than trying to just
get to 100%, like have
get to
all
100%.
the info.
Yeah. And you can't do it, and you fool yourself, and then you get attached to your beliefs. And you become inflexible, and you're like, no, darn it, this is how it's got to happen. I know it. I got all the data.
Unfortunately, I am a data digester, and I'll go down some
I'm not
deep...
saying you can't do it, but like, I don't know, it was Eisenhower or somebody said, planning is everything. Plans are nothing. Like, you got to go through the process. You got to spend the time. You got to form your opinions, but then you have to adjust to reality.
When I saw that graphic, I'll pull it back up just because it's a cool one. When I saw this graphic, very first thing I did was type into Google, why is September the worst investing month? And just go down that rabbit hole. One of the more interesting answers, I jotted down a couple, but the most interesting answer I thought was this is the time of year, September, where investors and funds exit the markets and they're trying to lock in their tax gains and tax losses for the year. Most of that sounds like it's done in the month of September, which could contribute to this. But to your point, I mean, who cares? We're kind of just spitting spitballs out there at this point.
Definitely. But it is real, which again, doesn't mean it's going to go down this month. Okay. Got to have risk management. This is not set in stone. It doesn't have to happen. We could have a rip-roaring rally for the next few weeks of September. So don't take this as gospel, but it is probability, and you shouldn't ignore it.
I'm gonna let this bleed into this. I don't think I mentioned this at the top of the call, but early this morning I drove back into Houston from Austin. Last night I had a few hours in the hotel room. I actually pulled this up and read through it. It's a little bit lengthier. I thought maybe I even wanted to summarize this, but I don't think I would do it justice. I was hoping maybe you could unpack just sort of your thoughts and where you sit here. You mentioned Catherine Fitz in our last meeting 2 weeks ago, that quote of all wealth comes from life. So I read through this. I thought it was great, man. You talk a bit about Bed Bath & Beyond. You talk about Zuckerberg. You talk about your perspectives. I just wanted to kind of pull this up, take a breather, see if you had anything to add here, color to add. I'll definitely make sure this is linked in our video and folks can go read it. It's a great piece.
Yeah. And this is something I studied in graduate school. I was at the Santa Fe Institute for a while, and studying complexity science, quote unquote. And it was actually, it had only been like 10 years or so since this guy working in computer graphics animation developed a few rules that he could that would then reproduce flocking behavior in birds. Okay, so you watch a bird flock, and you think, boy, if I had to program every one of those, I mean, you watch a flock of birds, if I had to program every single individual bird to simulate flocking behavior, that would be really complex. Sure. But he like sat on a park bench and watched the birds and came up with a few rules that kind of governed their behavior. And I forget what they are, but they had to do with, what direction, how to choose a direction, how to space yourself relative to your peers, and
separation, alignment, and cohesion.
Yeah. So and then like program those in a computer, and then lo and behold, like created some simulated objects, and they behaved exactly like a flock of birds. And he called them Boids, which I presume is the Boston pronunciation of birds. But it's fascinating, right? And it's really intriguing because you look at it and you go, whoa, could I do that for, the rest of reality? And I thought it was a good metaphor for kind of what we're dealing with in markets today, right? We're not dealing with birds, we're dealing with Boids, we're dealing with a simulation of reality, not with reality itself, right? And I think that the kind of simulations of reality are fundamentally limited, right? They're not going to overtake humanity. This idea of the singularity and artificial intelligence and that the robots are going to be running things and patting us on the head like little pets. No. So simulations are less powerful than life itself, right? But simulations are big business. And a lot of big businesses are very invested in us buying into simulation as reality. So we look at Bed Bath & Beyond, right? Like that was being presented as something real in the media, right? I remember there were these Bloomberg, financial journalists, normally fairly credible, interviewing the founder of Wall Street Bets about this move in Bed Bath & Beyond going up 400% in 2 weeks, and treating it like it was a serious event. Like,
here you
does this
say
have legs? How far is this going to go? Do you think that this is back? And it's crazy, like that's nuts. And so it's a game, it's a simulation, especially for, most everybody who might be listening to this, exchange between you and I, right? We're interacting. This is screen life, not real life. So screen life has different rules than real life, different decision-making mechanisms. And so we have to realize that, yes, to some degree, the simulations that we're interacting with are loosely connected to the real world, but less and less so every day. And it's much more about just the narrative and the simulation and kind of the story itself, and then interacting with that. And I think that's how we have to understand markets. My co-founder at Rhodes Sept, Justin, and I have been talking a lot this week, kind of hitting on the idea that what we're actually, markets are much more of an engineering problem today than they are a real world problem of evaluating businesses and deciding, who's going to make a profit and or just going to an index fund or whatever, right? So we really, I think in this simulation world, it's really an engineer's world, and we can be more effective in markets if we realize that we're operating in a simulation and that we need engineering skills,
Hmm.
because that's really, these are productions that we're interacting with. And we need the same tools that the pros have.
In this piece somewhere in here, you say you're like kind of what you did there of like, I remember vividly watching these credible interviewees talking to the head of Wall Street Bets, these folks that have,
Yeah.
to the moon. And I think you've just been in you've been in this so long. You talked about, you're able to sort of zoom out and see it for what it is. You're like, I kept waiting for them to like do the, like in the office where every once in a while they look at the camera and you're not supposed to know the
They
camera's
wink.
there, but they give it the old like, bleep, like, yeah,
Yep.
you know what I'm doing. It never
Yeah.
came. Yeah.
No, never came. But it should have come.
Yeah.
It should have come.
Um,
And people need to, once you realize that, very liberating, you're no longer burdened by the notion that this is some kind of, inevitable real world thing that has to obey the laws of financial physics. No, especially not on the time frames that most of us are capable of operating in, which is increasingly really short, right?
yeah.
So
In our last meeting, your 7 principles course had just gone live. I gave it sort of my self-endorsement or sponsorship, if you will. But at this point, if we see, and I'm going to pull this up, if we see the momentum it has now, my sponsorship, my endorsement doesn't mean anything. You've got more than 108 students that have taken this in the last 2 weeks. I don't show this to like re-talk about it or brag about it, but we talked about this when we first started this podcast, this interview sort of series. I come from the podcast world, and it is extremely daunting. It's extremely hard to take something that no matter how long you've been doing it, and put it to the public, like package it up and point it towards the public and allow people to digest it and give feedback and talk mess or give you good credit and email you. Like, it's just, it's a scary thing to do. You've now gone through that motion twice. This time we're sitting on Udemy. You're in the hot and news section, which is like the new and noteworthy portion of podcasting. It's a trending sort of course. You're crushing it here. You've got some good ratings. I guess the question is, how are you feeling, man? Like, you've got to have this weight lifted with this now in the public and getting good traction and feedback.
it is gratifying. You're right. It's not easy to do. And I got to give a lot of credit to the team behind the scenes who were able to come in and get the best out of me. And yes, it's my life experience. So it's great to have people seeing it and appreciating it. But the production matters. And if you have a great producer, it really helps to make you shine. So, so I think there's a lot of credit across the board. People behind the scenes don't always, get recognized, people behind the camera. But yeah, it's very gratifying to have it out there, to see people appreciating it. That keeps getting me out of bed in the morning to do it again another day. And I think it's good stuff. I'm proud of it. It's not clickbaity. It's not hyperbolic. And I think it's good common sense with some pretty good tools to back it up. So yeah, it's great. Love it.
I've got 2 questions, but I see my time. I'm going to maybe give you an option if you're okay with it.
Okay.
Do you want to talk about just briefly the merge, or last call, I hinted at your article, What is Wealth? And I brought my book. Which route would you want to take there? Just to quickly sort of, close this with.
Let's talk about the merge.
Cool. I think that probably makes more sense. This is supposed to happen next week, man. I won't spend long here. I know I'm on my time. We've talked about this the last 2 sessions. I'll just briefly sort of touch on what this is supposed to look like and how it's supposed to play out. This is now tracking, I believe it's the 14th, give or take, plus or minus a day. This is something, like I mentioned, we've talked about a couple times. Are you tracking this? The 14th, 15th, 16th-ish date? Is this something you've got circled?
I am paying attention to it, yes. And I
Yeah,
have to say, like, I did some research on it over the past week, and I came away more encouraged than I expected.
awesome. I'm looking forward to. I'll give my little rookie overview. I'm looking forward to your color and feedback.
Okay.
This merge has been long awaited, many times rescheduled, a project that's been circled since 2015. I'm showing a Vitalik tweet, which is from earlier this month, but this is the cool little diagram I wanted to show.
I've seen this. I like it too.
It's a good little graphic.
Yeah.
We'll talk about the problem first. Ethereum, just over the years, has continued to get more and more costly. Several things. As it becomes more popular, the decentralized finance piece of this, the NFTs, as people continue to pull this ETH lever and put it into use, this blockchain has endured serious bottlenecks and choke points and unpredictable gas price spikes and fees and transaction fees. There's a lot of unpredictable things that happen in this network. And so about a year and a half ago, and you can see the split here in October, they ended up splitting off what they called proof of stake, and they gave it a really cool name that I can find here in a second, and started to actually run this in like a proof of concept fashion. And so today,
The beacon chain.
Say it again.
Beacon.
That's it. Beacon chain. This merge, post merge, when we get on that beacon chain or to proof of stake, it's supposed to become 99% more efficient with energy consumption and usage.
99.95.
95, exactly. They've been testing that proof of stake for a little over a year now. They've got more than $13 million that have been staked on that network. And over the next couple of weeks, that merger will be finalizing. So with that underway,
what the merge means, right?
Exactly.
So what the merge means is that all the blockchain that's been on the proof of work based blockchain, right? All those transactions are going to move over to the proof of stake blockchain.
Yes, sir.
And it's not really a merge in the sense that the proof of work blockchain is going to stop. You know? And then the proof of stake is going to take over from there.
Totally.
So, this diagram sort of gives the idea of subway trains, which I think is a good analogy, right?
Yes.
Like these trains are running in parallel and you're going to get to a certain station, Union Station or whatever, right? Everybody was on the proof of work train is going to have to get off that train and merge onto the proof of stake train.
Yes.
And so, yeah.
Just real quick, the proof of work for folks that are like, what the hell does that mean? Proof of work is how things are being done today. Miners actually have to go out and buy expensive equipment. They have to go in and solve complex challenges to mine ETH or whatever they're going after at that point. The winner, the solver of that, gets a predetermined amount of Ethereum at the end of that challenge. It requires loads of energy. We talked about 99.95% more efficient once we make this merger. It takes loads of energy. It takes loads of expensive equipment and resources. It's expensive. With this proof of stake piece, instead of having miners buy all this equipment and go through this process we just described, they're now able to stake their coin. And in exchange, they earn rewards on that staking. Another cool thing on the stake piece, once you've hit 32 ETH, it gives you the ability to validate new transactions. And so I don't think very many people will be doing this because it requires a certain amount of technical wherewithal. And if you start to screw up, they'll actually start to chop your ETH, like they'll penalize you. But it gives you more control instead of relying on the energy portion of this and the miner portion of this. They're plucking that out and putting the control, the power in the hands of the stakers, which I thought was powerful. I'm headed. I guess where I wanted to go with this is we talked about this in the last couple of weeks, and in prep for today, and maybe for my own good, I was trying to find out what does this merge mean for ETH or for the crypto community or for anything like that. And I found, like most things in finance, answers on both ends of the spectrum. Some folks that are saying, well, the merge has been priced into Ethereum for several months, or since Vitalik put out this tweet, we've known it was on the roadmap and it's already been priced in. other folks are saying this thing's about to explode. I just want to put it in your lap and see, thoughts on the merge, thoughts on Ethereum. Is this going to be like a 2.0? I just want to get your thoughts on this.
Well, like I said, when I looked into it, I came away less skeptical. I still am skeptical that going to proof of stake is the best solution for reducing the energy consumption. But like I said, I'm less skeptical than I was. I guess my concern is that it's going to be, I mean, there's a lot of engineering going on here, but there's a lot of changes. These are huge changes to something that's supposed to be immutable, right? So there's a lot of coding, a lot of coders involved, and in some ways that's antithetical to the idea that these are immutable, unchanging, decentralized things, right? And so there's all these nuances to the economics of proof of work versus proof of stake, and which one's more egalitarian. And proof of work there's efficiencies of scale for miners, so the bigger you are, kind of the better are your profit margins. And so there's kind of incentive to be really big, even though on Bitcoin, for example, anybody can get, a small Raspberry Pi machine and run a node. And you don't have to be able to stake 32 ETH, which, costs you, set you back 50 grand or so right now. So to be a validator, essentially a miner on the Ethereum network where you can earn Ethereum for solving blockchain problems, you got to have 50 grand.
Yeah.
So not everybody can do that, but yet that proof of stake model does mean that probably there will be more validators, more miners, right? And whether you have 32 ETH or you have, 3 million ETH, there's not the same efficiencies of scale that there are in the proof of work space. So in a sense, it's a little more fair to the miners, and you don't have that sort of, economies of scale race to have the biggest server farms, et cetera, right? So it's interesting. I think it's very fortunate for Ethereum that this is happening right in the midst of an energy crisis. So I think there's a lot of positive PR for it. I've talked about BSV as being a proof of work scalable solution to the energy problem, and it does work over there too. And I feel like the proof of work with big blocks is an easier blockchain to understand. And the complexity of the Ethereum blockchain, I'd rather have something a lot more simple. So, BSV is that really simple proof of work, scalable chain that happens if you buy into big blocks. You have less decentralization, but I think it's a little more transparent. And it concerns me just kind of the complexity of the Ethereum network and all the layer 1 and layer 2 stuff, the off-chain stuff, the on-chain. Remember, like the one time I tried to do a play to earn game. I mean, I had to go through 6 transactions each way.
It's so wild.
My US dollars into the game and then back out of the game, and all those different times that you're transacting, you're running the risk of something happening that you weren't expecting, right?
Totally. Punching in a wrong number.
Just a simple proof of work, scalable blockchain like BSV, yes, you have, 10 miners, right? But it works. And so it's still interesting times. Overall, I think it's a net positive for Ethereum, but I also think it increases the uncertainty around Ethereum because there could be big problems. So there's more volatility, more potential upside, but more potential downside. And so you can actually allocate less to Ethereum, right? Because of the increased volatility, but still kind of keep your odds of, you know, something impactful to your wealth, if it is positive, you know, happening, right? As opposed to if you take too big a position, it doesn't go the right way, then you have something impactful to your wealth happening in the wrong direction, you know, and it's too big, right? So look, if Ethereum is going to change your life because you invested in it, you're going to have to be in it for at least 5 years. It's not going to be, you know,
next Friday,
right? I mean, there might be a spike, but it's too difficult. There's too many smarter people playing that same game as you. You know, if you really wanted to change your life, if you believe in Ethereum, and then you should be thinking 5 years, you know, and if the stock market crashes, like a lot of people think it's going to, Ethereum and Bitcoin are going to crash too, right? It's going to be risk off. So there's a lot of risk right now, and it's all about position sizing. Make sure you can survive the worst case scenario.
Totally. This is something that I will definitely keep my sort of finger on the pulse of over the next 7 days. Things are supposed to get really interesting for these guys.
By the time we talk again,
I'll have an update. We'll have an update.
We should know something meaningful.
100%. And maybe we'll both be driving Ferraris or something. I'm
thinking about doing some validating myself after I studied it more.
Nice.
And again, I think the energy, just the PR thing of much less energy consumption in the midst of an energy crisis is going to be a positive thing.
Never even crossed my mind.
Network.
It's a great point. Never even crossed my mind, and that's a great point.
Yeah.
I'm punting this what is wealth conversation. We're going to take it first in the next call, just because I've talked about it a couple times, and it's a badass article, man. So I want to make sure we talk about that. That's all I got for you today, man. We went a couple extra minutes. Thank you very much for
all right.
Your time
today. Thank you, Josh. Always great to talk to you. Have a great couple of weeks, and look forward to seeing you next time.
Cheers.